Now that we've taken a quick look at the history of housing finance in India, let's take a look at the various stakeholders who are involved in housing finance in India. The first, of course, are the lenders. The lenders being the housing finance companies, the banks, the NBFCs, and any of these lending institutions that give loans for housing. The second is the developer. The developer again can be a private developer, or it can be a development authority, a developing authority that is tasked with the job of constructing specific kinds of housing, typically low income, middle income housing. Of course, then there is the borrower, and the borrower means you and me as individuals. It also could mean developers, because we have housing finance into two categories here. One is loans to people like you and me as individuals to build, buy, repair, construct houses. And the second is the loans that developers take to start and complete a project and then sell it and repay these loans. So the developer is also an important stakeholder in this entire ecosystem. We then have the regulator. And in fact, we have two regulators here. We have the Reserve Bank of India, who sits on top of all the lenders, be they be banks, be they be NBFCs. Housing finance companies traditionally have been regulated by the National Housing Bank, which actually is a subsidiary, a wholly owned subsidiary of the Reserve Bank of India. In the last 2 years, the Reserve Bank, in order to create an even playing field, has removed some of the regulatory role that the National Housing Bank was playing and taken the mandate on itself. By doing that, they have ensured that the banks, who anyway are regulated by the Reserve Bank of India, the NBFCs, who are also regulated by the Reserve Bank of India, and now housing finance companies, are all treated in an even way, in a common way, as far as the regulatory and inspection requirements of the central bank are concerned. There are two other stakeholders we should consider. One is the credit bureaus and the credit rating agencies. The credit rating agencies, because if a developer is coming out with a bond issue or creating a lending instrument, the rating agency comes in and rates that particular instrument. The bigger role is by the credit information bureaus. Whenever any of you, me, an individual, applies for a loan, the lending institution will pull a credit report and get a credit score on the person who's applying for a loan. That will play a significant role in deciding whether the loan is to be granted or not, and if so, on what terms. More recently, the banks have increasingly recognized that good credit reports, good credit scores, actually can be translated into probably a lower rate of interest. We've had more banks increasingly looking at it that way, and that actually is a tremendous movement ahead in terms of recognizing that risk and reward have to go together. The sixth stakeholder is the insurance company. And here there are three kinds of insurance companies I'd like to talk about. The first, of course, is life insurance company. Having started giving housing loans right at the beginning, now they come into the picture because individuals who are borrowing will take a life insurance policy in the God forbid event that something happens to them. And if that does happen, the money that comes from the life insurance is used to settle the loan typically, so that the family which he has left behind is not in a situation of stress where they have to worry how they will repay the loan or will the house be taken away through an exercising of the mortgage. You then have the general insurance companies who insure property in terms of fire, floods, theft, etc. The advantage of that works two ways. One, of course, the individual benefits, because God forbid something like this happen and the property is insured and money comes in which helps him recover from the blow that a fire or a flood has caused him and his family. The second point is the lender also benefits, because if the property is severely compromised, damaged, then the general insurance pays for rebuilding that property or reacquiring another property. There is a third insurance angle that we need to consider, and that's a more recent development in India, although it has been prevalent in the Western world for a long time. And that is called mortgage guarantee insurance. There is one company in India called the India Mortgage Guarantee Corporation, and what it primarily does is it works with lenders and comes to an arrangement whereby individuals will get a little higher loan, maybe 10% more, 20% more, but the lender is comforted by the fact that the Mortgage Guarantee Corporation guarantees that extra amount that they are giving as a loan. For example, if I'm getting a 100 rupee loan, then the lender will consider me for say 110 or 120, provided that extra 10 or 20 is guaranteed by the Mortgage Guarantee Corporation. The benefit for the individual is either he getting a higher loan, or people who are not eligible for the loan they wanted will now become eligible. The lender reduces its risk by having a guarantee for a top-up amount, which is the extra amount that it is giving. It's a phenomenon which has been more recent in the country and is increasingly getting acceptance amongst lenders and borrowers. So these are the 6 corners of the stakeholders in the mortgage finance, housing finance industry.